It's time for more Auction Day on Your Money.
Most property investment experts will tell you that time in the market is better than timing in the market. You just sit tight and eventually the capital growth will just come. You just need to be patient and it's a long-term game.
But there's someone challenging that widely held belief. Joining us today to tell us why timing trumps time in the market is confessed property data junkie, Jeremy Sheppard. Thanks so much for joining us, Jeremy. Now, explain to us why you believe that timing the market is better than time in the market.
Right, well, first of all, thanks very much for having me back on the show, guys. There are a couple of reasons why. First of all, I was looking at some historical data and I noticed that in the vast majority of cases, most of the growth in property markets happens in a few short spurts of sudden, rapid, accelerated growth. And then that's followed by a prolonged period of lacklustre growth and even in some cases negative growth like we've got in Sydney and Melbourne at the moment. And it occurred to me that this is a waste. We're owning property for a long period of time where it's not actually growing. In fact, rough estimates are that really only a third of a property's lifetime is worthwhile owning a property. Most of that time you're just waiting for that next boom to happen. And I've brought along some charts, if now's a good time to show them.
Yeah, it is. Show us. Yeah, back yourself on this one.
All right. So if you can show the first chart, you'll notice that this is a cumulative growth chart of the top 4 cities in Australia. So we've got Sydney, Melbourne, Brisbane and Perth. Now, this is a 5-year period starting from 1990 and it goes to 1995. And you can see that both Brisbane and Perth won the race. They had the most amount of capital growth over this 5-year period. And Sydney was fairly lacklustre. It was barely managed to keep its head above the rate of inflation. And Melbourne was even worse. It had negative 5% growth. But you can see that Perth shot up in just a couple of years. And the peculiar thing about this chart is actually the growth of Brisbane because it's consistent. And what I mean by that is you see this steady, almost straight line over the 5-year period. That is actually quite rare, as you'll see in the next chart. We'll go to the second chart, and you can see in this second chart, it's the same 4 cities, but it's a different period of growth now. We're going from 1995 to 2000. It's the second 5-year interval. This time it's Sydney that's on the top, and both Brisbane and Perth were suffering at the bottom. In fact, they had, I think it was per annum growth of around about 3%. So you can see from these two charts how variable the growth rates are. And if we go into the third chart, now this was a peculiar case in the third chart. It's the next 5-year interval. It's the same 4 cities, but what we've got here is every property market had a boom. And this was one of the wonderful times being a property investor in the country of Australia during this period because the vast majority of the country had this tremendous boom. But you'll notice that in the first 3 years, Brisbane was coming last, and then in the last 2 years, it eclipsed the other markets. It had 70% capital growth in the last 2 years of this 5-year period. And this is the point that I'm trying to make, that most of the growth happens in these short, sharp bursts. Now, if we look at the next chart, the fourth chart, this is another 5-year period. It's the same 4 markets that we've got. And you can see that this time it's Perth's chance to shine. And again, it happens in the first couple of years and then it corrects. And you've got other markets like Sydney that are performing quite poorly. And in the last chart, we see Sydney back on top again. It had the best growth and the other markets were fairly lacklustre. Brisbane, it would have been almost a waste of time owning an investment property in Brisbane. And this is the point that I want to make about these. So, well, actually, guys, what observations, what have you noticed about these charts?
Oh, right, time for some feedback. I guess the main thing about looking at charts like this is that, you know, hindsight is 20/20. You can't really, you know, no city has followed the same path over the time frame that we've looked at. So it's very hard to know that what cities which city's going to do what next, if you know what I mean.
Yeah. I mean, that's a
leads-
great observation.
And it leads to a perfect point, Jeremy. I mean, looking at the historical data, it's great to point this out, and it's really quite amazing to see some of them almost like the tortoise and the hare. Some took off quite quickly and stabilised or came down a little bit. Others took longer and slowly got up in that period. But how do you predict that?
Well, first of all, I just want to point out some of the things that I drew from these charts, and this is why I believe in timing the market rather than time in the market. You notice that, first of all, every market had a turn at the top, actually with the exception of Melbourne, but it did quite well in plenty of occasions. So you notice that almost all the growth seems to happen in a few short years. There's almost every chart involves a major city of Australia having some kind of correction for a few years, and then that's followed by this prolonged period of very ordinary growth. If not, correction, it's just lacklustre growth, like low single-digit type growth. But every period of those 5 years, there was a market that was booming. So the key question or the opportunity that we're trying to capitalise on here is, can property investors jump ships and move their money around the country and actually always be in a booming market and avoid that 2/3 of a property's history where there's really no point in owning property? And you asked this question, how do we actually pick these markets of supply and demand? I just want to go through the case of an individual suburb, which I picked out. It's Menai. It's in the Sutherland Shire, and that's in Sydney. And Menai's growth rate over the last 10 years, that's from 2008 to 2018, was very typical of Sydney's market. In fact, the growth profile, when you look at the two curves, are almost identical. Now, property prices back in 2008, the median house price was around about 600,000. I think it was 595,000. Over the next 10 years, prices increased by 70% to climb to over $1 million. But the thing is, in the first 5 years, there was no point being a property investor in Menai. The growth was around about 20% in total over 5 years. Prices went from about 600,000 to a little over 700,000. It was about 23,000 a year that you were collecting in equity as a property investor. The second half of that 10-year period of 5 years, prices went from around 700,000 up to over $1 million, and they piled on about $360,000, which equates to about a little over 70,000 per year. So it's literally tripled the growth in the second half of that 10-year period compared to the first half. And that's why I believe that it's important that investors need to time their entry well into the market. Now, there's nothing wrong with spending a lot of time in the market. There was $475,000 of equity gained by Menai house owners in that 10-year period, but the vast majority of it happened in the last 5 years of that 10-year period.
Now, Menai is a pretty random example, isn't it? Like you sort of had to introduce it and say where it is. It's not a suburb that a lot of people would know. It's in the Sutherland Shire, but it's not one of the beachside suburbs or one of the waterfront ones. It's so why have you picked Menai as an example? And how could anybody else have possibly picked Menai as a place to have made money in that time?
Well, the thing is, Sophie, that the reason why I picked Menai is because it had a very typical growth to almost every suburb in Sydney over that 10-year period. The growth profiles were almost identical. So I was just picking it to show where we can look at actual dollar figures rather than just look at those capital growth percentages that I showed in the charts earlier. So there's nothing peculiar about Menai, and this is one of the things about time in the market. Sooner or later the growth will come, but when you're timing the market, you can get that superior growth. And it all comes down to picking when. You know, when are these markets going to have their boom? And that can be tricky for some investors.
But the cost, a lot of the thing that puts people off buying and selling property like that is how much it costs in terms of agents' fees and stamp duty and those kinds of things. So if you're going to be riding the waves of certain property inclines, you've got to be prepared to take a hit in fees and taxes as well, don't you?
Sure. Yeah, that's a fair point, and it does take a bite out of those profits, but it doesn't gobble the whole lot. So, I mean, let's look at an example, go through a simple case. So let's say you've owned a property for the last 3 years and it's had fantastic double-digit growth. Let's say you've got 36% capital growth over those 3 years. Now, a selling agent's commission will be around 2%. Is that right, James? Or actually, let's pump it up to 3% to include legal fees, maybe a clean-up, staging the property. Then on top of that, you've got to pay capital gains tax. So we said there was 36% of capital gains, but it's over 3 years. So you've got a 50% CGT discount, so you're actually only paying tax on 18% of that. And let's assume that the investor has a marginal tax rate paying 40 cents in the dollar. So that's 0.4 of 18%, which is 7.2%. We'll just say 7%. So you've lost 3% in agents' fees, legal fees, and another 7% in capital gains tax. And then you've got, you're cashed up and you're ready to buy again. You've got to pay stamp duty to purchase a new property, which is around 4%. And then there's building inspection, pest inspections, more legal fees. So really, all up, you're talking about losing around about 16%. That means if you're going to move your equity out of one property and into another, you've got to have that alternative market, that next market has got to outperform your current market by 16% just to break even. So you're looking at a 20% difference as a minimum to make the move worthwhile.
Yeah, look, it's amazing to see these figures that you've created and the graphs to show over time. And I'm presuming once we start to look at that graph that you can start to see a method and a flow from other suburbs and to sort of equip yourself with that knowledge. For people watching at home who are wanting to do that, where can they find this supply and demand data?
Right, yeah, good point there, James, because it all does come down to supply and demand. And this is the very reason why most experts in the past have said that you should just sit and wait. Don't try and time entry into the market or exit. You're better off just sitting and waiting. And the reason why is because they don't know where the next capital growth is going to come from. They don't know over the short term how much capital growth you're going to get. So rather than take that risk of moving things around and having that expense, instead you just sit tight. But the thing is, in the past, we didn't have access to nearly as much data as we've got now. There are predictive algorithms now. The introduction of big data being applied to real estate actually makes it relatively easy to have a significant amount more confidence in picking the short-term growth projections of these markets. And it all comes down to supply and demand. So as demand exceeds supply, you get price growth. But what happens when the price grows too much? You get unaffordable property prices, and that subdues demand. At the same time, you've got property developers capitalising and building more property, and that brings up supply, and so you get balance. And so the key to finding these markets is looking at supply and demand metrics. When you find a market where demand exceeds supply, and by a reasonable degree, then that represents an opportunity of perhaps double-digit growth. When the market has come back to balance, that's your trigger to sell.
It's a pleasure to have you, Jeremy.
Thanks, Jeremy.